from 1979 onwards. Why did I choose the year 1979? Because that is the base year for Sensex. Sensex was 100. You know Sensex? It has got nothing to do with sex. Sensex is sensitivity. So Sensex was 100 in 1979. Imagine a person who bought gold for 100 rupees in 1979. A person who deposited 100 rupees in the bank in 1979. And a person who bought the shares in Sensex in 1979. Look at what would have happened. I have taken the 5-year period here. 1980, 85, 90, 95, 2000, 2005, 2010, 15. I told you that if your time horizon is 5 years, there is no risk at all. This explains that. Every 5 years, you can see that the top is higher than the previous time. In between, there will be huge volatility. For example, in 2005, March, Sensex was 6,493. By March 2010, it climbed to 17,528. But in between, what happened? Crash would be a mild word to describe what happened in 2008. But then it recovers. And a person who invested in Sensex stocks 100 rupees in 1979, by March 2015, this was the Sensex in March 2015, 27,957, now it is 32,000. What does it mean? During this, how many years? 38 years, 37, 38 years. Gold multiplied 19.87 times, bank deposits multiplied 22 times, but Sensex multiplied 279 times. And you don't need expertise to buy stock. Now you have ETFs, exchange traded funds, right? You can buy the Nifty, you can buy the entire index, right? You know Nifty Bs? Nifty Bs, exchange traded fund. Suppose a person says, I have only 1,000 rupees to invest. Fine. Stock market is also for the arm army, not for the very rich people. 1,000 rupees we can start. So how do you start with 1,000 rupees? One easy way is to buy the Nifty. If Nifty is, let us say, now 9,800. Assuming Nifty is 9,800. 1/10 of Nifty is a Nifty B. Let us say 980 rupees. There will be accumulated dividend also. So let us say 1,000 rupees. So you are buying 1 unit of Nifty. 1 Nifty B is by paying 1,000 rupees. And for this 1,000 rupees, you are getting how many shares? 1 Nifty B. All the 50 shares in Nifty. You are getting Maruti, you are getting Tata Motors, you are getting Infosys, you are getting HDFC, you are getting Larsen & Toubro, you are getting Ultratech Cement, not 1 share each. 1 share of Maruti alone will be 7,800. But you will be getting fraction in proportion to the weightage in Nifty. Right? So this is what ordinary investors can do. So in the long run, this is what happens. I took only bank deposits and gold here because real estate is not a standard asset class because the price varies from place to place and locational factors are there. So I just took the gold and bank deposits, which are 2 favorites of the Indian households. So this shows you that stocks outperform all other asset classes. To invest in stocks directly, you need 2 things. One, you need expertise. You need time. As students of finance, of course, you have the expertise. You can acquire expertise. Expertise can be acquired, right? It can be easily learned. Those who do not have the time or the expertise can invest in the mutual fund route, and mutual funds are given phenomenal returns. Particularly SIPs. What are SIPs? Systematic investment plans, where you invest a particular amount of money during chosen periods of time. It can be 3 months, it can be 6 months, it can be ideally a month, it can be even every week. I've taken here the best performing fund, not the best performing fund, but then some of the best performing fund. I should have included also the worst performing fund. You take the SIP returns during the last 10 years. Returns in systematic investment plans during the last 10 years. A person who had invested every month. The compound annual growth. Look at this, some funds have given ICICI Value Discovery. This is a multi-cap fund, one of India's best managed funds. A fund managed by Shankar Indrayan, outstanding fund manager in India. 20.48% return every year. Remember, tax-free. But I was most impressed by the worst performing fund. Suppose some people, when I give lectures in my investment classes, investor conferences, some people come to me and tell me, sir, what you are saying is right. This share has gone up, that share has gone up, but all the stocks in which I had invested are steadily going down. My mutual fund is not performing. So I looked at that. The worst performing fund, SIP, has given a return of 9.2% during the last 10 years. And that has beaten the risk-free return by a huge margin. Remember, long-term capital gains are completely free and dividend is completely free. That makes a big difference. As a person from the industry in financial services, as the investment strategist of Geology, I may be a little bit biased in arguing very strongly in favor of stocks. You can discount it a little bit. But then the fundamental principle of investment is don't put all your eggs in one basket. Because if you put all your eggs in one basket, you are not diversifying your risk. You should be diversifying your risk, diversifying your investment. Therefore, you should have all the asset classes, many asset classes. You should have investment in fixed income, you have investment in bank deposits, you can even invest in the Arabian yellow metal, no problem. But part of your investment should be in stocks. Directly, if you have the expertise to do that, or indirectly to the mutual fund. Even though we say, don't put all your eggs, if you ask Warren Buffett or Raghel Jhunjhunwala, they don't subscribe to this philosophy. Don't put all your eggs in one basket. They will say, they have said, put all your eggs in one basket and take care of that. That is the contrarian philosophy. Geniuses can do that, but ordinary people should do some diversification. Warren Buffett got compound annual growth rate of 20.6% during the last 50 years. That's how he became the most successful investor in history. Outperforming the S&P 500 return by a wide margin. That was achieved not by investing in gold, which he does not do. That was achieved by investing in the most performing asset class of all time. So invest in various assets based on your risk appetite. Diversified investments, bank deposits, equity, debt, gold, PF, etc. But invest more in high return assets like stocks and mutual funds early in your career. Reduce your exposure to equity as you grow older. Generally, we speak about a thumb rule of investment. The exposure to equity should be 100 minus your age, right? If you are 30, 100 minus 30, 70% should be the exposure to equity, 70% of your investment, invested in funds. But if you are 60 years old, then 100 minus 60 only 40%. But then I don't follow that rule because I can afford to, that's why I've been an investor for quite long. Otherwise, as you grow older, your exposure to equity should decline as you advance in age. Invest in